first ever self-directed digital assessment tool for testing visual processing skills in children. Jesus, that you sound smart. We've got Mark from Xperia Growth, who brings business expertise to startups to survive the first 2 years. Amazing. Awesome. Okay, I know I said till 5 past, but I think it might be about time to jump into the session. I'm going to hand over to the wonderful Remco and Jason, who are actually going to introduce each other. So, and that's just been decided. So I'm interested to see how they do this. But maybe just before we jump into the session, I just wanted to give you a little rundown. If you've not used Butter, we basically on the left-hand side, you've got your reacts. So if someone says something really smart, you can put out a fire react or a thumbs up. If someone's asked a question and they're like, is my mic working? The thumbs up react works really well for that. Then on the side, if you have something, we encourage you to jump in and ask questions as we go through the session. That's how you're going to get the most out of it. So you can jump into the chat and I'll be watching that. And otherwise, if you've got a question that you think might be more appropriate to jump in and verbally ask, you can use the Q button and just say, I have a comment or a question, and then we can throw the mic to you when the timing is right. And then obviously jump into the chat with anything and I'll be watching that. I think there might be someone who doesn't have their mic on mute because I can hear some voices. So I'll just check out for anyone who doesn't. And then anyway, I'm going to hand over to Remco now to kick off and Jason to kick off the session.
Thanks, Megan. Howdy all. Let me just figure out the share screen in Butter. And we'll go from there. I can't see all of you now, but Megan, maybe you can let us know. Can you see our screen?
Yeah. Yes,
yep.
We can see you, cool. And I'll jump in if there's any questions in the chat.
All right. So yeah, hey all. So we're going to run this. We've got some slides to kind of keep us on track. Jason and I have talked together a couple of times before, so we're going to do a bit of jamming around that. As Megan said, just pop your questions into chat. I can hear the doorbell coming in, so more people are joining. So yeah, pop your questions in chat. We'll pause as we go through, but also circle back towards the end. Just for a bit of fun, right? I thought we'd mix it up. As I said, Jason and I have done this together a few times in different ways. All right. So just for fun, I thought we'd introduce each other. Jason, do you want to introduce me first, or shall I go the other way around?
Let's go. I'll introduce you, mate.
All right.
So, hi, everyone. Hi, everyone. Happy to be here. Yeah, so Remco is the founder of Standard Ledger. I've known Remco since I first started my first startup called Cake. Some of you might have heard of Cake. I won't talk about that because Remco is going to introduce me in a minute. But Remco helped me build the very first version of the Cake platform and Cake software. He helped educate me on what an ESOP was. So that's quite a cool origin story of my startup journey. So yeah, Remco's been around in startups longer than me, so it's got to be 10 years or more. He's one of the more well-known and experienced and passionate, startup people in the country, and he's specializes, as we're here to talk about today, financial matters. But as it says on his website, if you're after a regular accountant, you may have come to the wrong place. I regularly send my founders to Remco because I always say, if you have a traditional accountant, they're most likely going to F up your startup's books. So you have to go talk to someone like Remco who understands what they're doing, and then you're much more likely to get a good outcome. So yeah, that's smart. Hey, great to be here with you, Remco, yet again. We must have done 20 of these by now. But anyway, yeah. Good to be here again.
Cool. So thanks, Jason. So let me tell you about Jason. As you said, we've known each other for a long time. We've done this a few times now. So when Jason and I first crossed paths, he was starting this little startup called Cake Equity. On a mission to make equity available to everyone so that everyone can participate in the growth of the startups. First here in Australia and now kicking awesome goals in the US. so yes, met Jason when he was starting that, and early angel investor just for a small bit. So as a shareholder,
that's right.
It's been
that's
nice.
Right. Hopefully making you some money by now. Yeah, that's cool.
Looking forward to that exit. So yeah, Jason led the charge there for many years. Still sort of sits in the back room, surfing now, and has spun up Torus to do exactly kind of what we're talking about today, which is to help founders on their startup journey raise capital, also raise to fund himself, operating on the Torus plan, and is the heartbeat of the Gold Coast tech community. So there's a whole lot. I reckon there's actually more interesting things happening in the Gold Coast at the moment than Brisbane. And a big part of that is kind of some of the ecosystem that's evolved around Cake Equity and Jason and the strength there. So did we miss anything about each other, Jason?
Oh, mate, I think I should have you introduce me every time. That was great. Thank you.
Cool. All right. So just to be clear, do you want to say anything else about Torus, Jason?
No, I mean, along the way, I'll at some point I should maybe at the end I'll just say like this is what Torus does or something like that. But
cool.
I'm totally committed now to helping pre-seed and seed stage companies get funded. I have been committed to that for 10 years as it is. I raised a bunch of money in Australia from angels and VCs in the US. I got Jason Calacanis to invest in Cake. So I've done a heap of this myself. I've been committed to this for years, and I'm happy to build a company around it. I'm very proud of that, and we're helping founders all the time to get funded. And pumped to help you guys learn today.
So that's what we share in common. It's probably why we love hanging out with each other. So like to share. Yes, I'm a service provider. We provide services around a bunch of things. Jason as well at some level, and we've both invested ourselves or raised investment ourselves. We've raised a bit as well when we expanded into the UK, and glad to share some knowledge. I'm just flicking up a bit of an agenda. Both Jason through Torus and ourselves through Standard Ledger, we've kind of got a structure where we talk about getting investor ready. Right from the funding journey, how do you get yourself ready, talk about your financials clearly from our perspective, valuation and cap tables, which is always fun. How do you get yourself ready around data room, pitch deck, and a little bit of thinking post-raise. Understand from previous sessions in the campus, the AFC Campus, we've talked a lot about the process. Is that right, Megan?
Yeah, we talked about actually how you go and approach investors with Iceberg. Yeah.
Great. So for today, kind of to complement those previous ones, we've been asked to talk particularly about timing, valuation, and cap tables. Valuation, we can talk about for the whole session, and how to manage investor expectations, and then jump to Q&A at the end. We'll kind of, between us talk for, let's call it half an hour, quarter two. But happy to stop along the way. Megan's going to keep us honest, watch the chat, and pause the talking. And other than that, I'm just going to throw up a couple of slides to jam around.
Do you want me to kick off by actually chucking in the poll?
Yeah. Oh, thanks for the reminder. All right, let's. Not sure how all this works. Yeah, throw up a poll.
Yeah.
Thanks, Megan. All right.
Basically, we've got a question here. What stage are you at with your fundraising? So we've got a couple of options. Just thinking pre-seed, seed, Series A, here to learn. So if you can jump in there, that's going to help us sort of understand where the audience is at.
Should we see this pop up somewhere?
Has it not popped up?
Oh,
no. Okay.
Hang on. I'm sharing, so it might not for me.
Oh no. Okay. I've seen a thumbs up. Okay. So I think that people should be able to see it.
Cool.
Couple of thumbs up. That's good.
Great.
Good to know everyone knows how to use the emojis.
I'm just going to do it in real life because I'm sharing. Do we wait a couple of minutes?
You can keep going actually while it's still up on the side. So that's fine.
Cool. All right. I'm glad you guys can all multitask. All right. So let's talk a bit about timing from a couple of different perspectives, right? I threw in there. And Jason, again, run with it, interrupt me, all of that. From our friends at 5V Capital, Cut Through Ventures, this is the quarter two's investment update that they did. Keenly waiting any day now for quarter three, for end of September quarter. But just to talk about, what's the investment market been like? Frankly, for the last couple of years, it's been pretty shit, right? You can see a big spike, that was happening back in 21. A lot of people raised, and then for the last couple of years, it's actually been pretty quiet. And as always happens in the final quarter of the year, like the one we're in right now, there's a little blip up last quarter, just before December. We're getting our hopes up in the first quarter this calendar year, and then they were dashed a little bit in the second quarter, right? So kind of the timing matters in the market, right? So it's been a bit patchy this year. Is that what you've seen, Jason? Oop, you there?
Yeah, quite patchy. Deals still happening, but patchy for sure. I think AI is creating opportunities, but it's also creating a bit of a bit of uncertainty. Investors don't like uncertainty, and everyone's looking for exits. Hasn't been enough exits, so liquidity's a bit dried up, and so it has been a harder year. But definitely seeing some improvement in the US. I'm seeing improvement. They normally lead Australia, so definitely seeing improvement in the US from a capital raising perspective for both funds and for companies. And a bit of secondaries happening, a few IPOs happening. So I'm more optimistic, but it has been a bit of a hard time.
Yeah. So as always, sort of market determines, and so through the last couple of years, there's also been down rounds happening, right? As people have been squeezed and doing extension rounds. Some of the survey results, I'll try and make that a little bit bigger on the right there. From that last report, we're talking about what a valuation's like. That's kind of preempting what we're going to talk about later, right? And essentially saying, about 2/3, I'll just roughly say, valuations are holding steady, which is actually good because last year, there were more people in the downward expectation, right? And there's even some sort of shoots on the way up. Jason, what's it like? Because people are approaching Torus to raise money through you as well, right? What are you seeing?
A lot of flat deals, yeah. A lot of bridging rounds, a lot of flat deals. Very few up rounds unless it's like, brand new company going from pre-seed to seed. Very few seed stage companies getting to Series A with an up round. Definitely is happening, but it's not as common as it was. I think it's also important to be realistic. We had a huge bubble, and that's burst. And this is roughly kind of how it's supposed to be. So we've gone back to the mean. But I think good companies that are being built the right way are getting funded. More financial prudence. Good sort of financial acumen. Strong businesses that have good financials and unit economics and things like that. You just need to run the businesses, better than you did, 3 to 5 years ago, which is a good thing. So yeah.
Cool.
We're going to talk about that today, I think.
We will. We'll talk more about valuations. Megan, any updates on the poll in terms of what stage people are at?
I just ended it. So we've got 13 here just to learn, 7 pre-seed, 7 seed, 1 just thinking, and as probably expected, no it's Series A.
Yeah, and probably as to be expected for the audience today, most people are here to learn, right? Which is great. Which means if you are raising or starting to think about raising, you're at that pre-seed or seed. As Joe said, that probably means there's no expectations for your company because it's the first time you're raising, right? Whereas people further along that have raised, particularly in that bubble, right, are having to sort of navigate existing investors and expectations.
Also, it's good to overlay a little bit of realism. So if you have a look at that chart, right? I mean, I can't see that now because I'm like slightly old eyes, but
which one?
If you look at down across and up, if you think about a portfolio, it's actually pretty reasonable. 30% are up, 60% are like across, and then some are down. Like that's pretty normal because in 20 company portfolio, like 5 are going to fail, like 5 or 10 are going to muddle through, and then a handful are going to do really well. So that's actually quite a balanced response, I would have thought, because that's kind of how portfolios evolve anyway.
And in many ways, it's a return to balance, right? Because whether we liked it or not, in the last couple of years, there were more in the down rounds, right, happening.
And there were way too many companies getting funded. They were getting funded even though they shouldn't have been. And that's why we're having down rounds, because they never bloody were going to make it anyway without the free money that was around.
So we've got our first question, sorry.
Yep.
So Mark has said, how does the investor requirements for better run businesses apply to pre-seed?
No, I'm happy to jump on that one if you like. So with pre-seed, you don't have a lot of data, but you can still act in a professional manner. In my opinion, it's more about showing the professional attitude that you have and showing that you understand what's important at pre-seed and what's important at seed and what's important at Series A, and that you understand the journey that you're on. You understand where you are at on that journey. And so when you're talking to investors, you can't show them, years of historical records, but you can show them that you understand what you need to be learning. And you can show them that with their money, you're going to learn the right things and you're going to think correctly. And by the time you get to the next round, you're going to be advanced in all these areas. So it's all about awareness, professionalism, being thorough, and those types of behaviors, which is in your pitch deck, it's in your financial model, it's in unit economics, it's in the way you answer questions to them. All that element of professionalism, I think, is super important to showing investors that you're going to be able to cut it.
Yeah, and so just run a business well, right? Everyone's going to be tight with cash to start with. So are you managing that prudently? And the extent to which you can demonstrate that means that if you're managing, let's call it your money early on, well, the investors will go, they're more likely to think you're going to manage their money as well once it goes in. So they want to put their money into a safe pair of hands. Definitely pre-seed, you've got, essentially whatever's in your financials. You don't have a lot of metrics necessarily, other than acquiring new customers. If you're at that stage that you've built your product and you're out there, so whatever early stage metrics you've got is also useful. But most investors will kind of accept that you haven't got all your ducks lined up quite yet. But to the extent that you can just show how you're prudently managing your business, it's just business at the end of the day, whether it's startups or not. All right, so that was context of timing, right? And useful segue, sea of numbers on here, right? So thanks Mark for that question, right? All you're trying to do, and this is further along than pre-stage, right? That I'm showing on the screen, but it's basically, can you show, right, that you know what you're managing appropriate to the stage that you're at? How did we go? Are we looking ahead, right? Are we making sure we don't run out of money too soon? And this also plays into the investor confidence stuff. We talked about managing investor expectations as well, right? So I said, as you're starting to build all this stuff and just running a good business, the collection of this stuff ends up in a data room for the investors to look at as well. Jace, anything to add to that?
Nope.
Okay, let's keep going. We touched on metrics too, right? So we get a lot of people that go, hey, what about my rule of 40? And there's a gazillion different metrics you can have, right? So very much, we get people sometimes coming to us and going, hey, can you build us a 10-year financial forecast? It's like, well, pretty well your first forecast is just going to be you in a spreadsheet on one page. Metrics, it's all about, are you getting your first customers? Are you keeping them, right? So in all things, it's appropriate to stage. So I just want to say again, from a timing perspective, right? Are you tracking those things? Are you able to show that you're tracking those things and paying attention to it? So then investor looks at it.
We have a question as well. I'm going to give the mic to Janine. I hope I said that right.
It's okay.
Hello.
Jenny.
Hey, Janine. Oh, Genevieve?
No. We can hear you, yes.
Amazing. I was just curious to understand, in terms of the financial overview that you displayed in the previous screen, you did mention that that's for a company or a startup that's a little bit further ahead. For that are seeking pre-seed funding, what are some of the considerations from a financial reporting standpoint or projections that investors would like to see? Do we need to have the detail of, for example, cost to acquire and all of that for a single customer? Can you just, I guess some quick bullet points of what we might need to cover?
Yeah, the cost to acquire your first customer is you probably doubling down and spending days with them, understanding what they need, right? So it's not as important to get an absolute number right, but CAC, right, which is that customer acquisition cost, is one of those things that will matter next stage, all right? So one of the things as soon as you close a round, you already should be thinking about what the next round investor will want to see. So if you've got something like CAC, you go, look, we're kind of roughly paying attention to it, right? But we agree it's not refined. The investors should, by and large, accept the fact that, for the stage that you're at. But essentially, you've probably just got your P&L, right? And a little forecast going. And I'll call it a one-page forecast, right, at the pre-stage level.
I'd love to, I'll jump in on this one as well. So for me, there are numbers that you can know, and there are numbers that you can't know at pre-seed. You are where you are. You're at a very, very, very early stage. I believe that you can and should know some numbers even at pre-seed. There must be some kind of traction number. It doesn't have to be revenue, of course, because it's pre-seed, but there must be some sort of like website hits, website hit growth, social media hits, some sort of social media hit growth. If you're paying anything, like there must be some data around your traction that is either the pre-revenue, top and middle of funnel data to show that people actually give a shit. And then if you do have any kind of revenue or any kind of sales, even if it's like your uncle or your sister or anyone, if you've got any kind of sales, I would be, so do what you can, measure what you can. If you go to pre-seed and you say, hey, we haven't got any revenue, and they're like, well, have you got anything, any growth numbers or any go-to-market numbers at all? And you go, nah, like that's going to be a red flag for them, because it either shows that you don't have any and you don't know how to do it, or that you don't know how to communicate it. So it's really important to have some sort of traction data. I think the other things that you can measure is any kind of usage data, any kind of engagement data. If you've done any beta testing, like what did they say? What was the score? Like any kind of beta testing data, any kind of usage data, engagement, retention that you've done in pilots, that stuff is really important, especially if it's positive. Like if there's any customer love, really champion that data. That is what investors love the most in pre-seed and seed, is like the founder, and then any kind of customer love, like it's so critical for getting investors over the line. So yeah, so traction stuff, customer love, engagement stuff, really, really important. And then when you're looking forward, for me, as Remco said, a basic, like bottom up, really simple 12-month forecast that you can't do any longer. It's impossible because it's just too many moving parts. So when they give you the money, what are you going to do with it? And then some sort of like a revenue model. There has to be some sort of revenue projection. And these are all assumptions because you don't know yet. So like, we're going to spend this much money on this, and I'm going to spend this much money on this, and then that's going to get us this much of this, whatever, whether it's website hits, whether it's sales books, calls, whether it's actual sales, whether it's revenue. There must be some sort of like revenue model with assumptions in it. And then the way you communicate it to the investors is, look, we don't know. These are our assumptions for these reasons. And we're going to be testing this all the time. We're totally committed to our data and to learning. And that sort of mindset will really help you. I've just put a Medium post in there from Batco. You should all know or know of. We'll be looking to learn from over time. Really, really nice post that he did on financial modeling. You might find useful as well, just how to think about it and how to communicate it. It's super important.
I'll find his profile and I'll chuck it in there as well, because he does do some really good posts, especially for early stage founders. We've also got another question from Mark, and he has said it would be helpful to have a quick definition of pre-seed and seed if there is time, which I could probably just find a link to share with it. But what is the typical pre-seed raise average amount?
So with Torus Club members, we're doing I think 350 on average at the moment for pre-seed, and we're doing about 750 for seed. It can range anywhere from 250 to $1 million, I think, for pre-seed, beside the crazy exceptions. And then I think seed can range anywhere from probably 500 to 2 or 3 million, or 5 million, I guess, at the top end.
They're not strict definitional, right?
Not at all.
By amount. Pre-seed is roughly seen as friendly money, and seed is seen as professional money. right? So pre-seed being angels and families and friends. So it's more by sort of stage nature of investors, and seed.
Yeah, I think with pre-seed, the milestones you need to hit with pre-seed.
Yeah.
I think the milestones you need to hit for pre-seed is like you need to have some sort of product. So you need to have a prototype, beta, ideally an MVP. Ideally, you've got something in people's hands and a little bit of usage, but you don't have to have revenue for pre-seed, in my opinion. You do need to have some sort of traction and proof that like people care about it. But again, it doesn't have to be revenue. So some sort of product, some sort of usage, some sort of traction. Then you can probably get a pre-seed done, and then with seed you have to have like some sort of real revenue. I think in almost all cases, in Australia particularly, because we've got more conservative investors. I think in the US it's totally different. Like people throw millions at shit with no revenue everywhere over there, but absolutely doesn't happen in Australia unless it's like 5% of deals. So, you're talking 5, 10, 20, 30K a month type stuff for seed in Australia, even 50K plus some VCs. Like they say, hey, we're a pre-seed investor. And then they go, have you guys got like 500K ARR? And you're like, oh, anyway, so
yeah.
Not to hassle VCs, but it's probably in that 10 to 50K a month like range for seed. But you could be doing that manually. So what sometimes people don't understand is like you're not necessarily like a fully built product that's fully scalable and all your marketing systems are built and your product's high margin to be getting that 10 to 50. You can still be really hacky and the thing can be really messy, but you're still getting revenue in that sort of seed stage. Because the reason you raise seed capital is to really build out the MVP into something that's like really, really strong and scalable. So that's what the money's for. So you don't have to have an amazing product to raise seed. That's what the seed money's for.
And so some ideas of traction, raise some money. It's all an experiment to try and get to like the outcome of the pre-seed going into seed is here's this next additional proof point, particularly around revenue and more traction, right? And that's what I mean about paying attention to what the next stage wants, right? So your whole job going from pre-seed to seed is build on that revenue. Absolutely not focusing on profits yet, which is probably why you still need to raise your next round.
Pre-seed is kind of to take a crappy product that kind of looks like it's got potential and build a proper MVP. And then seeds to take an MVP and turn it into like a really good product that's kind of scalable.
Cool. All right. We'll keep going. Last thing on timing. Guess what? It's already October, guys, right? We sometimes hear people saying, hey, I'm starting my round now and I'm going to close by Christmas. The best I can say is we had one of our startups, they were further along, 3 mil ARR from, we were warming up investors for about 12 months, right? We said, we're coming out right on this date, and it took us 5 months to close, and all of the metrics and traction was going up and to the right in the right way. So if you haven't already started like 2 months ago, you ain't going to close this year, right? So timing does matter, and everyone goes on holidays in January, right? And so if you're not already in market talking to investors now to try and close by September, you're really talking about February.
Yeah, so for those of you, because I've lived through this and it's extremely stressful, for those of you whose runway runs out in the next like 4 months, just look at your runway, get with your real close investors now, get immediately in just the minimum amount of capital you need to make it to February. Because you can, but then really, pitching in February, you're banking the money in March, April, May, somewhere. So I know it's hard. I know some of you in the situation, I feel for you. So just be smart, be careful. The way I'm coaching my members at Torus at the moment is you've got to be, for those of you that still need raise this year, you've got to be pitching in October, all the commitments done by the end of this month. And then you're like signing and banking in November, which can sort of like maybe go into the first week of December at the latest. And then it's really hard to get anything done until Australia Day. So just reiterating and expanding on Remco's point, in Australia, it's kind of like that. So what I'm doing with my guys, if you want to raise in February, March, April, you start preparing now. So you're talking pitch deck, cap table, financial model, all that stuff. You start now. It takes a few months to prepare. You come back on a straight A, go time. You start pitching and everything.
And the only thing I'll add to that is send out some teasers pre-Christmas saying,
Totally.
to people that are of interest, right? Going, hey, I'm not talking to you now, but here's a bit of what we've been doing. See you the other side, basically. Right.
Yeah, there's a very famous saying. I think Dean McAvoy first said it to me, which was be a line, not a dot. You can't, no one's going to, a dot is like one meeting. You can't roll into someone and say, hey, I'm awesome, give me money. Like, it's 0.0 chance of that happening. They only invest in people that they've known for months. And it doesn't mean you have to be best friends, but they have to have seen your brand, be getting your updates, like do a monthly update, just presumptively include them all on it. And they won't always look at it, but some of them will, and they'll see your name. And then when you come back in February, you've got a much, much better chance of getting success. And like again, with that, I'm talking like go to events, post on LinkedIn, stalk them on LinkedIn, message them on LinkedIn, message them on email. Like for capital raising, the investor readiness, the investor relations part, it's like heavy, and you got to start. You got two choices. You can start now and do it for 3 or 6 months before you need the money, or you can start when you need the money and you can do it while you're broke. And that probably sounded a bit harsh, but it's like better to start sooner rather than later.
Yeah, and that whole thing of managing investor expectations starts before you're trying to really hit them up as well, right? So if you add them to effectively an investor update, 3 to 6 months out, right? It's really important to say, not raising right now. Here are the things we're working on over the next 3 to 6 months, and make sure you actually deliver on those. So, and it's kind of like, hey, it's just me again. Those things we said we were going to do, we've done them now. So, we'll be in touch in a couple of months' time. So you're already showing a version of the traction that Jason was talking about.
We've got 2 quick questions in the chat. Do we need to structure our company business in a certain way before going out for pre-seed funding, i.e. like PTY Limited?
You need to be able to raise shares in something. Yes.
Right. Yes, so we need to be PTY Limited.
Yeah, with my sometimes accountant hat on, hit me up if you want. But yeah, create a company. You guys got to figure out stuff between yourselves. Right, as co-founders and trusts and things like that. Obviously, you don't want to spend money before you have to, but yes, you need to have a company. Like if people are joining the Antler program, as an example, they create the company, during that phase.
Perfect.
Yeah, and then if there's multiple co-founders, you need a shareholders agreement, you need a vesting agreement. There's a bit of work to be done. Not necessarily a shareholders agreement, but you absolutely need founder vesting and all those sorts of things.
Yeah.
Jai has also asked, who are the people of interest, Remco? Is LinkedIn cold messages or emails the best approach for drawing the line Jason mentioned? One thing I will note is actually the previous session and AFC Campus is all about actually how do you approach these investors. So I can pop the link in here, but I'm interested to hear your answers.
As Jason said, it's stalk people. I was at SAS Summit yesterday. Who was there? Rampasand was there, and OIF were there, and Cut 3 Ventures was there, like 5V Capital. So the investors are around and kind of broadly accessible for discussions. Next week, South by Southwest, right? There'll be a bunch of them around there. They're generally up for a chat, right? So all you're trying to do is, as Jason said, be on their radar, right? As you go through, right? There is no easy way of doing that other than making yourself more visible over time. But yeah, do it in time rather than be the dot.
I agree.
Dot. Right. So
the biggest thing, the most important thing, and the most effective thing is to be known. Go into the communities where the investors are. They are approachable. They are available. You have to network hard. So every networking event where there could be investors, you got to be there. Accelerators, incubators, community groups. You have to be known as one of the best up and coming founders, one of the biggest hustlers. Great to be around, delivering. You've got to build a brand of someone that is backable. That takes time. you can definitely do cold outreach. You can definitely do LinkedIn. You can definitely do LinkedIn posting. So LinkedIn is our online community. So as well as going to all these in-person events, get on LinkedIn, show that you're building, show that you're delivering, tag people, comment on things. So I think, yeah, definitely getting involved. And then to save your time, find people that care about what you do. So for example, if you look at the Airtree open source investor list, even though it's a bit cold, it is a great list. You want to, like, if you're in health tech, find health tech investors. If you're in space, you need people to invest in space, and so on and so forth. So you need to find investors that care about you and what you're doing, that will actually give you the time of day. And if they give you the time of day, try and find a few of them that could really be your champions, and help you grow, and then they're the ones that are most likely to be your lead investor. For those of you that haven't heard that term, it's an absolutely critical term and role in a capital raise. And what that means is they'll be the first one in. They'll do the hard work. They'll stake their brand and reputation on it. They'll do DD, and they'll take that cornerstone piece of your round. So you want 3 to 5 people in your CRM that kind of look like that, and you want to spend the lion's share of your time with those people, building trust, listening to them, showing you deliver. Much easier to get your round done if you can get 1 or 2 people like that over the line.
And
You're basically
plus, they're so
showing
smart.
them-
You can learn a lot from them.
yeah,
Sorry.
don't steer yourself blind on the VCs, right? Either. So yes, that list, that open source list. Backhoe's also got an updated list of that.
There's 500 angels on there as well, just so everybody knows.
Yeah. So adding to what Jason said is, if you are talking to people who already understand you, your business, and the problem you're trying to solve, they're usually people in the same sort of business area you are. They are perfect angel investors, right? You don't actually have to explain a whole lot. Like if you're going in cold to a VC, they've actually got to understand your business first. But if you're talking to someone that's in the same area, they are the perfect angels to talk to. Someone that is aligned with what matters to you and what will matter to them. Sorry, Megan.
Yeah, like 50 or 100 hours desktop work will save you months of pain when you're capital raising. Like when you look at a VC, look at their portfolio companies. If there's nothing there that looks like you, cross them off the list. Like honestly, like people invest in trends and in niches, and they're all like that. So like create a little box of people that look like they know what the hell you're doing, and double down on them.
Yeah. Cool. Going to keep us moving. Let's flip brains to valuations. Right. So I've just talked about ask, round size, and valuation. Jason and I'm going to have some fun here. So number one is how much money do you need? Right. We've talked a bit about financial models, and basically kind of the graph on the left is just trying to show how deep your cash need goes. So you should be able to do a 1-page spreadsheet of what you need for the next 12 months and go, I need a couple of $100,000 because particularly at that pre-seed, Jason was saying the average is 350, right? How much do you need, right? And so that's your ask. That's how much you need, right? And it gets a little more sophisticated as you go further on, but essentially it's as simple as how much you're going to need for a reasonable amount of time, allowing for the next round, right? And you're looking for 12 or 18 months, right? So that's how much you need, or the ask. Jason, do you want to talk about dilution and targets and all of that? Round size?
Yeah. So as you put there, most rounds are diluting between 10 and 20%. So what dilution means, it's that you start off as a founder or founders, you own 100% of your company. And after you raise a round, you'll own 90 or 80% of your company. In very simple terms, that's what dilution is. So each time you get money in, they obviously get some equity in your company. So you own a little bit less each time. 20% is pretty standard for rounds like seed and Series A and things like that. Pre-seed, I like to see it a bit less, but investors sort of still like to get 20 at pre-seed too, so there's a little bit of argy-bargy there. But so with your pre-seed and seed round together, you probably want to dilute max 20, 30% if you can. So each time you raise, you own a little bit less of your company. You want to try and keep that as small as possible. But remember, investors, there is a market out there. You might be new to this, but investors aren't. So you can't go out with like a weird val and a weird dilution and say, oh, we're only giving away 2% or anything like that. I mean, it's just not going to work. So you do want to try and understand the market for dilution before you go out. It'll just make your life a lot easier. Yeah, I agree with setting a modest raise amount with the target. I also like to have a range. So I think you want to just say you need, so 600 to a million. Just say you're raising seed, or you might say, look, we're raising 750 to 1.2 or something like that, and you really need 750. If it goes well, you get 1.2, 1.5. Can get oversubscribed if it's hot. But remember, the more you raise, potentially the more dilution you get. So you got to be really careful. You're always triangulating between how much money you need, how much dilution you're happy to take, and the valuation that you get. And it's like, you've got to be sort of always thinking about those things and how they impact each other. And, having somebody like Remco or myself around during that process, I think is extremely important, because if you're not financially minded, it's very easy to muck this stuff up. I've made plenty of mistakes, and I'm a 20-year finance professional. So do make sure you got finance people very close to you that understand this, that have seen this, that have been through it, because when you're raising, just so many questions that come up around that.
And, at this level, Jason talked about staying in a zone, basically, right? Your aim's not to close a deal on your first meeting. It's to stay in conversation, right? So if you go in and say, I'm only prepared to give up 5% of the company, you're just, out of the zone of what people are used to saying, and you probably won't continue the conversation. So, all of you right now, you can pull your phones out and your calculators out and go, I'm raising 500,000, divide by 20%, all right, there's the sort of average amount you're going to be giving up, equals a valuation of 2.5 mil, right? And all of the sort of the pre-seed investors know that, essentially it's somewhere around the 2 to 4 mil, right, is the range at which, early stage companies are invested. A couple of those traction points, you might have a couple of shit hot developers, etc., or people that have been in the market or had their own startup before. They're all, outliers in a way. But, every investor is expecting something in that zone. So your ask is both the amount you're raising as well as the percentage you're giving up, right, need to be in the zone. So if you go after pre-seed and you're 500 million, 20%, if your next raise is 1 to 2 mil, right, the 20% rule still applies, right? So it's a really just, we do more sophisticated valuations for a living, but they still always come in that sort of range, right?
Yeah, in an ideal world, when you get to Series A, you want to have what, like 60%?
Yeah.
But that's actually pretty rare.
Yeah, 50% is probably more reasonable, right?
It is really, like, in an ideal... Like, if you really want to do the absolute best dilution and raising you possibly can, you bootstrap through pre-seed and you raise seed and you hit, you just hit every metric and you're growing really nice, and you go Series A, seed Series A, and you've only diluted like 20%. That's the absolute, then you raise Series A and you dilute another 20%, plus you got your ESOP, right? So the absolute blue ribbon path, you own like 50, 60%. But in reality, most people do pre-seed, seed plus. So it gets pretty wild.
That's a very good tip, Jason, right? So if you basically replace pre-seed with investors with somehow bootstrapping your own money, right, that's probably the safest way through. So probably just worthwhile talking about, and just keeping track of time as well, safe notes, right, and valuations there. Jace, do you want to talk about those?
Yeah, totally. So they're both like considered equity. If you looked at your big long list of who owns what, they're going to be in there, but they're not like shares. These are like hybrids, kind of. So investors give you money now, and you give them a safe or a note, and then that would convert into shares in the future. Very common for pre-seed, very common for like in between seed and Series A, sometimes even for seed, but not so much in Australia. They're a great instrument. It's faster and cheaper and easier to do, which is why people do it. The biggest issue is valuation. It's very hard to value a pre-seed company. Sometimes it's very hard to value like a company that hasn't hit the Series A metrics, so that's why you sort of use it. But the downsides of it is you don't really know exactly how much equity they're going to get. Like if you sort of, if you don't hit the val cap, those safe investors can actually end up with quite a big chunk of equity in the company. So you've got to be careful with your modeling. You don't want to raise too much on a safe, in my opinion. And you want to raise on a safe, and then you want to raise a share round next time. So you're like converting all your safes and not having a big long list of them. It's easy to get them out of whack. So I think they're a great instrument. They are cheaper and easier and faster to do, but there are some risks. So don't do too many. Just be careful of the numbers. So again, having someone like Remco and myself around to help you understand your cap table modeling is really important, so you don't muck it up and overly dilute yourself. I'm sure there's more to add. I might leave the rest to you, Remco.
Yeah, well, I'll do a plug back at you and the platform you helped build to start with at Cake Equity. 100% underpin what Jay said is people go, it's an unpriced round. I hate that phrase because it's not unpriced. There's a price to it. There's still a notion of a value in there. Like instead of doing an equity round at a $2 million valuation like we talked about, you might do a safe note at a next stage valuation of 3 to 4 mil, right? But we often see that founders are surprised about the conversion impact of the convertible note when it eventually becomes equity, right? So there is a lot of consideration that keep your eye on that, right? Either in a funky spreadsheet, and they are funky, Jason, I can tell you, or you can do it natively through Cake Equity as well. But yeah, so most
and just quickly on that, well, you touched on a really important point there.
Yeah, go on.
You touched on a really important point, which is the valuation cap. In my opinion, if you're roughly worth $1 million now, and when you raise your next round, you're going to be worth $2 million. My personal opinion is that the val cap should be at around that $2 million mark. It's a protection mechanism that it's not meant to be the valuation now. And investors, this is another one of those argy-bargy things where investors can quite often say, well, if you're worth $1 million now, we want the val cap to be $1 million now. Well, I think you should just do a share round then, because what they're getting is they're getting a capped upside, like getting a capped valuation, plus they also might convert lower. So it's very investor friendly to do it that way. And sometimes you do have to accept that. And this is all part of the dance, but just be aware that the val cap, in my opinion, is meant to be set about a year in the future when the next round will occur. And that's to protect you founders on the call.
That's right. And I'll put it in there as well. It's a guess at what that future round will be. So yeah, it is a valuation in equity, or it's a future valuation in safe note. That's probably the biggest takeaway from this. So
yeah. So the discount is the benefit they get for investing now.
Yeah.
That's the benefit they get. So yeah.
And sometimes there's interest rates, but that's usually when investors find it funky, or you get I'll call it unsophisticated investors, like some angels or their accountants who are trying to grab some money from a startup along the way, right? The whole point is it is intended to convert to equity. It's intended to be an equity risk investment, right? It's not intended to be interest from a bank, right? So it should be as simple as discount rate, valuation cap, done, right? But yeah, pay attention to that val cap. Cool. We big cap tables. It's just saying the same thing. Managing investor expectations. I'm just going to do a quick whip through this, Jace, if there's anything that, because I think we've touched on it going along. So traction inspires confidence. We talked about managing expectations. So whatever you can demonstrate the traction as you're going into the raise, right? You're telling your story through pitch decks. There's a bunch of pitch decks all round, including from our favorite investors, right? Again, showing confidence that you can show what you've done and where you're going. During the round, anything about sort of investor confidence there you want to talk about, Jace?
No, I mean, given time, I think you got it all under control, mate.
Yeah. All right. Let's open to questions. I'll stop sharing. Megan, if you can.
Rochelle, did you have a question around the options? Did you want to come in? Oh, okay. We got a question. I'm going to say your name wrong again because I didn't catch it last time. I'm going to jump in.
It's okay. It's Jenny. It's like Melanie with J and two N's.
Okay, mate, love it.
Janine, got it.
Janine, yes.
Janine.
I was just curious. I'm currently a solo founder, and how does that place in terms of trying to seed either pre-seed or seed investment? I am looking out for a CTO, but I'm just building at speed at the moment and going with what my customers need and want. But yeah, just curious about how that might land in the VC landscape.
Jace, you want?
I always look on the bright side. There are investors that don't care about that. Then just find them, and then show that you can do it. So show that you can do it all yourself, and show that you can build an amazing team. Like 2 founders might need 5 people, and 1 founder might need 6 people. Just show that it's not going to inhibit you, and that you're going to tackle all the problems and that you can do it. And then just go find the investors that don't care that you're a solo founder, and there are plenty, even though it's not all of them. Some of them won't do it, but I'm an optimist. I just find people that are on my team, and then I go that way.
At the tech level, it's never been easier with our friendly AI to build stuff. There's already discussions about unicorns with 5 people in them, right? Because they're leveraging the shit out of all the latest tech. Just personally, I for myself love having a co-founder to bounce things off, right? So it's useful to me, and investors will go from there. Rachel had a question. Yeah. Liz is saying, shared a story. Hey, Liz. Of someone that raised 1.2 million as a solo founder. There you go, Janine. Right, it's good to inspire. Thanks, Liz.
Cool. I've got a couple of people saying they're keen to get access to the deck. I will chuck that into the Slack today, and otherwise you'll all be added to the newsletter where we share like the recap and the slides and everything there. Rochelle, okay, you can't get mic to work. Feel free to chuck in your questions if you want in the chat as well.
Adam, trying to look for fund to buy machines. Basically, your CapEx funding. Talk to a bank, all right, or use your credit card. Sorry, it's there are definitely businesses that are more CapEx heavy. It sounds like you're working in the waste kind of section, right? Amongst sort of renewables, there's often a whole lot of equipment needed. Right, and you'll get some investors that are happy to invest a combo of debt and equity, basically, which is what you're.
All different investors.
I
always think about a funding strategy. It's not. It's not like we go raise a round. It's like, right, based on my business, I've got grants, I've got pre-seed, I've got friends and family, I've got a bit of debt. Like you can build a stack of funding mechanisms depending on what the use of funds is. So yeah, think about it that way as well.
Yep. Cool.
Amazing.
Lucky last, maybe. Amit?
How would you suggest B2C startups approach fundraising, pre-seed, seed locally?
Look, I would have always said it's going to be very hard, but possibly these days with AI, I think there could be a surge in B2C investment. I'm not sure. I feel like there has been a bit of a shift because, but historically in Australia, it's very hard. So what I would do is go and find investors that have done B2C before. Go and hit up the founders of B2C companies that have been successful. Even maybe talk to people that have been successful with e-commerce. So again, like we said before, whatever niche you're in, you're probably only going to get money from people that have invested in it before or that have done it before. And it is a smaller market in Australia, B2C investors, but they'll be there.
Okay, cool. And Rochelle said she's going to actually reach out for a chat. But any comments on investment attractiveness for social enterprise?
Well, it either has to make money or, like a social, I mean, is it a social enterprise that's going to like make a lot of money as well? So there's different types, right? So what type are you? If you're like a unicorn with a social, like say maybe who gives a crap, that's one type. And then there's ones that are like much more like they might be using a triple bottom line or something like that. And then you're going to have to go to a very specific group, of which there are far less, but they do exist. So again, I think it's about knowing your investors, finding the right investors, going to them.
and there are impact investors around that go, we want our cake and eat it too. So people like Giant Leap Fund, right?
Yeah.
They 100% invest into businesses that do well, but they also want to see VC-like terms, right? So when you approach them, they go, well, how do you meet the Millennium Development Goals, right? So
I remember I pitched them cake one time. I was like, oh, cake helps founders and founders help the world. And they were like, sorry, buddy.
There you go.
Craig has a comment as well. I think he wanted to add to that. Cool. You should have the mic now, Craig.
Unmute. Hi there. Hey, great session. I just wanted to comment to say yes. My biggest thing, I've found that it's pointless reaching out to people that aren't in your world, whatever you're creating. You might think you've got, like, we obviously, we all think we've got the greatest thing since sliced bread, but people want to invest in things they already know about. It's, Warren Buffett, a classic example. He doesn't invest in anything that he doesn't know. The other thing I wanted to say is it to Jenny, that as far as female founders, I have found that there are angel groups that specifically want to invest in female founders. So good on you. Just keep going.
Thanks, you, Craig.
Yeah. Scale investors.
There's more than ever.
Yeah, more than ever. Still way up underrepresented, right? Well, we can all acknowledge that. But yes, more than ever.
But improving, thankfully, I think.
Yeah. All right. Megan, do you want to take us away?
Yes, we're going to wrap up. So thank you so much. I've seen so many comments in the chat saying this was a really good session. So people love what you had to say. They've obviously taken something away from it. I'm going to chuck in I'm going to put in some links to each of the businesses in the Slack channel as well. You'll get an email with the recording at some point. But thank you guys all for joining us. And thank you, Remco and Jason.
Thanks, guys.
It was a brilliant
Thanks,
session.
everyone.
Thank you.
Good luck out there.
Have a great weekend.
Ciao for now.
Bye.
Thanks, Megan.
Guys.
Thanks, Remco.
Thank you.
See you all.
Thanks. Bye.